Can Americans abroad invest directly in US stocks and exchange-traded funds? Well, the first question is, what kind of an account are you going to have? Because brokerage firms have different policies in the US depending on where you live. Most US brokerage firms actually don't want to deal with expats, so that's the first issue. But provided you've cleared that hurdle, you should be able to invest in US stocks and bonds. ETFs are sometimes a problem depending on where you live. For example, if you live in Europe, it may be difficult to invest in US exchange-traded funds and mutual funds in a US account, but you may be able to do so through a US-based advisor. And this is as a result of US PRIIPs regulation, Package Retail Investment and Insurance Products, which basically mandates that funds, ETFs, mutual funds have certain kinds of disclosure statements. The European ones have them and the US ones don't have them, and so it's a European regulation that gets in the way. But Europe is a heavily regulated place, and in other parts of the world, this may not be a problem. So what are the pros and cons of investing through US versus local accounts, local to where you live? Well, some of the pros for US accounts are that you have SIPC insurance, which is $500,000. Usually this is much lower outside the US. Low fees. The US is a very competitive marketplace, and therefore you generally have lower fees than you would investing outside the US. In many parts of the world, it's like the US in the 80s, where you invest through mutual funds, which have front-end loads and so on. The other issue is fiduciary standard. In the US, registered investment advisors and other financial professionals usually have a fiduciary standard. Not all brokers have a fiduciary standard. And outside the US, generally you have what's called a suitability standard, which is a lower level of legal protection. A fiduciary standard means that your advisor has to put your interests ahead of their own, essentially. And then finally, we have a wide array of investment products available through US brokerage firms because it's such a well-developed marketplace. But some of the cons having to do with US investments are that you may have limited access to non-US exchanges. You may not be able to buy directly on European or Indian or other exchanges. That's difficult to do through US brokerage firms. And also, of course, there's a limited choice of brokerage firms and advisors you can actually deal with that deal with expats. And then what about the local firms? What are the pros of investing through local accounts? Well, quite often you can match the currency in which you're spending. So if you're in Europe, for example, and you're spending in euros and you have a local account, probably it'll be denominated in euros. And a lot of people want to avoid US politics these days. They think there are some risks maybe to having their money actually in the US. But you should be aware there are risks all over the world, not just in the US. And then what are some of the detriments, some of the cons of investing locally? Well, we already mentioned generally higher fees. Also, most local investments, most non-US investments are mutual fund based, which can create a US tax reporting issue. And then you also have a limited choice of firms that want to deal with you as a US citizen. Most won't want to deal with you. And so finally, understand what the local investment actually is, because sometimes there's a language barrier. For example, we had a client in Mexico who was told that they were getting a 10% interest rate on their investment. And this was a time when interest rates were at zero in the US and even low in Mexico. And what they were actually talking about, what the Mexican banker was talking about, was an investment in the Mexican stock market, which had happened to go up by 10% last year, which is very different from getting interest. So how do expats avoid triggering PFIC taxation with foreign mutual fund? Well, the easiest way is just to avoid these funds altogether, frankly. But there are also no PFIC issues in pension accounts, what are called pension accounts. And under tax treaties, generally IRA accounts will qualify as pension accounts. So to the extent that you want to buy foreign mutual funds, you could do it in an IRA without triggering the PFIC rules. What role does real estate investing play for Americans abroad? Well, real estate is a great way to invest in local currency. The flip side is that it's not a very liquid investment, so you have to be committed for a longer period of time. But if you invest in rental property, for example, then you can generate a cash flow in your local currency that will help you diversify your investments and also get that euro or whatever pound exposure that is helpful if you're spending money in those currencies. Real estate also has relatively minimal US tax reporting, especially if it isn't rental property. If you just buy a property and don't rent it, then there's really practically no US tax reporting until you sell it. If it's a rental property, obviously you have to report the income. But you need to understand the local market. Sometimes there are lots of agencies out there that want to sell you non-US real estate as an investment. Well, it's a good idea to actually check it out, to actually go there, see what you're buying, see what kind of the market is. Generally speaking, real estate is a good investment where people are employed if it's going to be rental real estate because they need to pay the rent for you, right? And so understand the market. Don't just buy blind. And then finally, there may be foreign ownership issues. You may need to buy through an entity. For example, in Mexico, you can't generally, as a foreigner, buy property along the coastline. You need to buy it through what's called a fideicomiso, a trust, a Mexican trust. And this may exist in many other places. And in fact, in many places, especially in Europe now, they're cutting back on second homes, higher taxes on second homes because there's sort of a real estate crisis and prices have gone up for real estate for the locals, so they're trying to cut back on that. Can expats access alternative investments like private equity or real estate syndicates? U.S. investments may be limited to U.S. residents. So if we're talking about private equity, U.S.-based private equity, you should check whether you actually need to be a U.S. resident to invest in that. And similarly, it could be true outside the U.S. If you have some kind of a fund in Germany, in Spain, or somewhere else, it may be limited to tax residents in those countries. Also, non-U.S. investments may trigger the PFIC rules. They may be considered passive foreign investment corps if they're in some kind of a pool type investment. And you may not get the U.S. tax forms you need for tax reporting. You may not get the 1099 forms if it's a non-U.S. based investment. So how should Americans abroad balance retirement versus taxable investing? So first of all, you need to consider the tax regime. For example, in Spain, there's a difference between taxation of what they call savings, which would be an individual or a joint account, a brokerage account, whereas a much higher rate is applied to other types of income, which would come out of, for example, retirement accounts. So the tax regime is important. Also, things like Roth accounts. Roth accounts are generally not mentioned in tax treaties, and so you expect to get money out of a Roth account in a tax-free manner. But that may not be the case if you're subject to taxation outside the U.S. and that account isn't mentioned in the tax treaty. You may not be able to contribute to tax-deferred accounts either. If you're working, you want to contribute to IRA accounts or 401ks, that may not be possible if you don't have any U.S. source income. What about local pensions? Should I invest in local pensions if I have employment in a non-US country? What happens to those accounts? Well, generally speaking, if you have something like an employer match or you get some kind of tax benefits out of this, and if it qualifies as a pension under the tax treaty, then it's probably a good idea to avail yourself of those pensions because you can treat them like retirement accounts in the US. Eventually, at a certain age, you'll be able to access them and they will create another cash flow for you. Should I contribute to a foreign pension plan? If you're living outside the US and you're working there for a local employer, you might be able to contribute to a local pension plan. And the question is, should you do that? If you're there for a substantial period of time, then probably it's a good idea, especially if you have something like an employer match. So for example, you can treat these pension accounts just like you can retirement accounts in the US, and eventually when you're retired or later in life, you'll be able to take money out of them, and you might be able to take money out at different times. For example, British pensions can be accessed at age 55. In the US, you generally have to wait to age 59 and a half to avoid penalties. One thing is you should make sure that it actually is a pension under the tax treaty and it's treated as such, because otherwise it may just be a taxable account for US tax purposes. And so, for example, in the UK, there are ISAs that you can contribute to, but these are not considered tax-deferred accounts under the tax treaty, so they're subject to US tax, even though in the UK you would get the money tax-free out of them. How does currency conversion impact returns for expat investors? Well, major currencies, so if you're talking about US euro, US pound, major currencies tend to be mean reverting. They're not like the stock market. They don't keep going up for long periods of time because of inflation and so on. They're mean reverting, but over long periods. So you can't really count on the fact that at some point your dollar is going to be worth whatever your dollar was when you moved to that other country. Then there's devaluation risk. If you live in what we would call an emerging market, let's say Mexico or Argentina is famous for this, that local currency could be devalued, so be careful how much money you keep in that local currency. And finally, converting through banks can be costly, so it's better to use currency conversion services like Wise or MoneyCorp. So how do you ensure that your investments remain aligned with US tax rules? Well, the easiest way is to invest through US accounts. We always counsel our US expat clients to keep their investments in the US, and then local investments could be savings accounts, could be term deposits, that kind of a thing. Avoid PFICs. Again, individual shares, interest-bearing investments, term deposits, those are not PFICs. Bonds, those are not PFICs. But non-US mutual funds and exchange-traded funds, those can be PFICs, and they'll create US tax reporting issues for you. And finally, if you have a pension account, ensure that your tax-deferred accounts qualify as pensions under the tax treaty so that you receive reciprocal treatment under US tax laws. Tax-deferred in one country, tax-deferred in the other country. That's what pension accounts under the tax treaty do for you.